So problem 8.3, we look at it here. Let me get to my notes on it. Okay, so it looks like at the beginning of the year, Plumbers Sports Center bought 3 used fitness machines from a company. The machines were overhauled, installed, and started operating. The machines were different, therefore each had to be separately recorded in their own accounts. So essentially what's going on here is they're saying, hey, we bought 3 machines, machine 1, machine 2, and machine 3. And what they want us to do is, in this example, is compute the cost of each machine. And then once we compute that cost, record depreciation expense for year 1, given these particular facts. So these are kind of like the step 1 items, right? Gather your information. So let's look here at requirement 1, require cost. So we said, right, we have this kind of timeline of a fixed asset. So when you buy it, and we could say, at the end of its useful life. And we said, right, when you buy it, you're going to capitalize your fixed asset. And then also any of those, incremental costs like sales, tax, shipping, installation, basically all of the costs ready until once it's placed in service. So, in this case, what are these? They're fitness machines, right? So we'll just say it's like a Bowflex or something. I don't know what I'm going for with this machine, but here it is. It's up and running. There we go. What are our costs? Every time we have the costs, up until it's, running, we put it in service. That's why it says prior to use. We're going to debit fixed asset, debit fixed asset. So what this means is, that's a bad Bowflex. That's not a good Bowflex. I don't know what that thing looks like. I'm not claiming to be an MFA and teaching art here, right? I'm teaching accounting. So essentially we have our purchase price plus our installation costs plus our renovation costs prior to use. So that's a big important word, right? Prior to use. Because once it's up and running, so here onward, we're gonna basically expense, 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 unless it's a capital improvement. So like, we have a building and then we put an addition to it. We talked about that. Generally small, ordinary repairs you expense along the way. So here looks like we have our purchase price, 11 grand. We paid $500 to get it installed. And then prior to use, we paid $2,500 to renovate it. What that means is our cost, we debited fixed asset 3 times, each one of those. So our cost for this guy is going to be $14,000. Likewise, same thing for B and C. We did the same thing. We paid the installation costs. We renovated it prior to use. So we're going to have 30 plus 1 plus 1. That's 32,000. Then this guy, it's going to be 8,000 plus 500 plus 1,500. That's going to be 10,000. There we go. Step 1 or requirement 1 is done. If only it was like this on the exam, right? If we could just have, get the costs for us. I know, I wish I could make it that way. I don't write the textbooks, I just teach them. It could be worse, right? I could use like accounting puns or something, or like try to be like the nerdy accounting professor. At least I try to make it a little bit fun, like realistic. If I wanted to get like geeky, Like there's some accounting jokes, right? Like it's a cruel world, like accrual accounting, right? It's like a pretty bad one. What are some other bad accounting jokes? Accountants would like these. Everybody else would say, go get a life, right? They want to know our depreciation expense. So remember, we said when we're calculating depreciation, we have two steps. Step one, we've got to gather our information. So we need to know our cost, we need to know our residual value, and we need to know our useful life. So for machine A, right here, we know the cost from up above, which we've just done, 14,000. For machine B, we know the cost is 32,000. And for C, we know it's 10,000. Notice how cost there is not just literally the cost, right? It's all of the costs that you incurred up until you placed it into service. We're given the other information over here. So it looks like A has a residual value of 1,000. B has a residual value of 2,000. C has a residual value of 1,500. Useful life, they're giving us some different characteristics here for it. So 5 years, we think this machine's gonna last. The second one, we're saying 60,000 hours. So we think we can run this machine 60,000 hours before it clunks out. And then for the last one, it's 4 years. So they want us to record depreciation on these assets. We completed step one. We gathered our information. There we go. Now let's do step two, which is essentially applying a depreciation method. Well, they've told us what depreciation method they're applying to each asset. So it looks like straight line, units of production, in double declining balance. And we know from the PowerPoint what these formulas are. So for straight line, we know our depreciation expense equals, how we calculate it each year, is our cost minus our residual value times 1 over the useful life. We know under units of production, our depreciation expense equals our cost minus our residual value over estimated total units of production times actual production. And then double declining balance, we know our depreciation expense equals our cost minus our accumulated depreciation times 2 over the useful life. So one of the things how you could easily get confused on this is it's always for the first two, cost minus residual value, cost minus residual value. For declining balance, it's cost minus accumulated depreciation. So don't always think it's cost minus residual value. That might be how I kind of trick you on the exam, right? It'd be easy just if they were all the same. They don't like to make it easy. They got to make it, pain in the butt. So let's work our way down here. We got our facts. Now they're asking for year one of depreciation. We know the methods they're using, straight line, and we just said, hey, we know what that is, how to calculate it. So it's going to be straight line. Our cost here, 14,000. minus our residual value, it's going to be 1,000 times 1 over our useful life of 5 years equals 2,600. So 14,000, we got that from over here. Let's check it off. Residual value 1,000, we got that from right here. Let's check it off. And then 1 is part of the equation, 5-year useful life. We got it from right there. So that's where we got those pieces of information from. So we're looking at $2,600 depreciation for asset A. Let's do asset B. So this one's, we're going to take our cost, which we know for asset B is 32,000, minus our residual value, which for asset B is we know is 2,000. We're going to put that all over the estimated total unit. So the facts here, they tell us, hey, estimated, we think this thing's going to last 60,000 hours. So that's going to be our total estimate of what we get out of this thing, 60,000. What that essentially equals is 32 minus 2, so it's 30 over 60. That really just means 50 cents an hour this thing costs us to run. So that isn't part of the equation, but if you were to solve for this and look at multiple years, you could just use 50 cents each year. But we said, hey, actual production for year 1, let's see where they give us that at. We know units of production, estimated useful life. It's here somewhere. Is anybody seeing it? I know it's 4,800. Right above required. Where's required? Up at the top? Or, oh, there we go, 4,800, right? I knew I was missing highlighting something. You guys should have called me out on it. They like to hide things like that. So I knew it was 4,800 because I just did this problem earlier today. So when we take it, that means we're going to have 50 cents per hour, which is basically this equation, times 4,800. That means our depreciation expense is going to be 2,400 for B. So 2,400 for B. Finally here, and we're getting cramped in space, so I'm going to do what everybody does in their notebook, right? When they run out of room, they just kind of draw like the line of demarcation. So for C, we know here we're using double declining balance. So it's going to be our cost in this case, which is 10,000. Given that it's year 1, we haven't depreciated this thing yet. So it's going to have 0 accumulated depreciation. This was just the first year. We haven't accumulated any depreciation yet. And it's going to be 2, which is part of the equation, over useful life years, 4 years. So when we do the math on that, it's going to be 5,000. For C. So right, we know the depreciation on machine A is 2,600. We know the depreciation expense on year 1 for machine B is 2,400. We know the depreciation expense on machine C is 5,000. So what they want us to do here, let's see if they have requirement 2. So they want us to give the journal entry to record depreciation expense. We just talked about what is depreciation expense, right? How we calculate it. It's these three numbers. How do we actually do the journal entry for this guy? Well, essentially what we would do here, right? We would debit depreciation expense, or just depreciation, like debit depreciation. So we know it's plus expense minus stockholders' equity, right? For 10,000. Then we would credit accumulated depreciation for machine A, credit accumulated depreciation for machine B, and credit accumulated depreciation for machine C. And those would be respectively 2,600, 2,400, and 5,000. So in other words, these guys right here, our total depreciation for the year, when you add these three up, this, and this, is 10,000. That's why we debit depreciation expense for 10,000 and then break out the accumulated depreciation for each asset. So that was 8.3. Let's look here at 8.6. So this one, when we're looking at it, let's just go to the question here first and see what's going on. What are they asking us to do? So they want, some journal entries related to the disposal of each machine. And then they want to explain the accounting rationale, which I can tell you when we make the journal entries. But remember, we said if they're disposing of the machine, as a general rule, you're going to take what you received, right? Your amount received, so $100, minus your carrying value, which is your net book value. So let's just say it was like $70. So that means you would have a $30 gain. It's just a really high level example of what they're doing here. So they're giving us some assets, machine A, machine B, and machine C. They're giving us some facts about it. Hey, what did we originally pay for it? Right here, original cost, residual value, estimated life, accumulated depreciation. So one of the things we can do just looking at this right off the bat is we know that we can back into the net book value, right? Because that's cost minus accumulated depreciation, right? So if we need the net book value here, we can get that pretty easy. But let's look at each of the items here, and let's start with A. So machine A, looks like we sold it on January 1st for $5,000 cash. So let me zoom out a little bit here. So we sold it, first off, let's just say this is on January 1st, right? If it's on January 1st, then that means we haven't taken any additional depreciation for this current year. In other words, you only accrue depreciation expenses at the end of the year. This is at the beginning of the year, the very first day. So time hasn't passed yet such that we would take a depreciation expense. It wouldn't be reasonable. It doesn't follow the rules. So we know here, in that case, zero depreciation, none is recorded. And when we're doing a journal entry, that's what they're asking us, we know that we got $5,000 cash. So debit cash, $5,000. That's pretty easy. That's one of the items here. We also know, in this case, that we have the machine A on the books how it's presented is at net book value, which is the cost minus the accumulated depreciation. However, those are two separate accounts, right? It's not like you just put net book value as a journal entry. You put two different items. You put accumulated depreciation and equipment. So what that means is we got rid of this asset when we originally bought it, right? We debit machine A for $21,000. It stays on there at this, and then slowly we reduce from it every year accumulated depreciation to get to our net book value. It's still on our books at $21,000, but when we report it, we also report our accumulated depreciation. Why I say all of this is we sold this machine, right? We don't have it anymore. So what we're going to do here is when we bought it, we debited it. Now we have less machine. So we're going to credit, in this case, equipment or machine A for $21,000. Likewise, it looks like our accumulated depreciation here is $15,770 or $15,750. So what that means is every year we debited depreciation expense, credited AD. We've done this every year we've owned it. And right now we have a credit balance in accumulated depreciation of $15,750. Well, we sold this machine, we got rid of it. Bye. When we get rid of the machine, we also have to get rid of the associated accumulated depreciation with it. So if right now it's sitting on our books at a credit balance, to get rid of it, we have to debit the accumulated depreciation. So that means $15,750. So here's the deal. We have our debits on our left and we have our credits on our right. We know every journal entry has to balance. In this case, it looks like we have roughly $20,750 on the left, and we have $21,000 on the right. So how we make our debits equal our credits, in this case, is we're going to debit a loss for $250. So that's how you would do it with plugging in the journal entries. Another way you could think about this is just say, hey, what did we sell it for, right? We sold it for $5,000. What was our net book value? Which in this case would be 21 minus 15,750. So let me get the calculator out. So 21,000 minus 15,750. That means 5,250 is the net book value. So we have it on our books and records, when we show net book value 5,250, we only sell it for 5,000. That means we're at a loss of 250. So that you could do it plugging in. The easier way to do it is if you just think debit, start with cash, get rid of the machine, get rid of the accumulated depreciation, and then plug it. That's one way. Another way is just think about what you sell it for in light of what its carrying value is. So let's look at B here. We got to do the journal entry for this guy. So this one's a little bit different. When we look at it right here, a big thing we would immediately jump out at us is that we sold it on December 31st. So for the first one, we sold it in the beginning of the year. So there was no time that had passed that would warrant a depreciation expense. However, the second one, we sold at the end of the year. So we need to account for depreciation expense on this asset. So that means for B, step one is figure out depreciation expense for the year, because depreciation expense will in turn affect our net book value, which in turn will affect our gain or loss on the sale of the asset. So it all links up, right? It's all a big building block one after the other. So it looks like accumulated depreciation. How do we do this here? Well, it says what method are we using on machine B. Prior year disposal, 12% note. Oh, this is interesting too because they're giving us a note for it, so it's not just cash. Prior year disposal. Here we go. I highlighted it yellow. Straight line. Hidden again. Why can't I see these things? They're supposed to be jumping out at me. So we know for this how we would calculate depreciation if we look at machine B. So we got our facts, then we got to apply the facts. So it's going to be our $50,000 cost minus our residual value here is 4,000. Residual value times 1 over the useful life of 10 years. So that means our depreciation expense is going to be $4,600. Now what we have to do is make the journal entry for that. That's step 1. Debit depreciation expense for $4,600, credit accumulated depreciation for $4,600. But check it out, we just increased our accumulated depreciation. So what that means is we in turn have to increase this guy here by $4,600. So that means our adjusted accumulated depreciation would be $41,400 after we take into consideration we sold it at year end. Because we sold it at year end, we have to account for depreciation. So that was step 1. It was basically just taking care of depreciation for the year. When we did that, we had to update our accumulated depreciation balance. Now, step 2 is, let's do the journal entry for the disposition. Now this one, like I said, this is a little fancy. Looks like not only we got some cash, $2,500, so right off the bat, let's get cash out of the way because we know that's the easiest. Debit cash, $2,500. We also got a note receivable from them, so an interest-bearing note. They gave us a signed agreement. They're going to pay us in the future $8,000. So we now have more of an asset. We know receivables are an asset. Debit note receivable, $8,000. And then that's what they gave us, those two things. Now what we have to do is we have it on our books originally. What did we buy this guy for? $50,000. That means when we bought it, we debited machine for $50,000. So now what we have to do is credit machine B for $50,000. Likewise, sitting in our balance right now in accumulated depreciation is $41,400. So we're going to, if it's sitting in there at a credit, we got a debited accumulated depreciation, $41,400, to get it totally off the books, right? Bye, see you later. We don't own that anymore. So, we have to remember we said our debits have to equal our credits. In this case, to make them balance, looks like we got more on the left than on the right. We're going to credit a gain for $1,900. So that can be a plug, the gain, $1,900. So that's what I was saying. Up here, we plugged the loss. Down here, we plugged the gain. And you could do it where you just think about it logically, get rid of each of the items, and then plug the difference to make the equation balance. Or you could say, hey, what did I receive? The fair value of these two things. What was my carrying value of what I got rid of? So my machine and the accumulated depreciation. The difference is either going to be a gain or loss. Let's look at C. So on January 1st, this machine suffered irreparable damage from an accident. On January 10th, a salvage company received the machine at no cost. So it looks like there was a work accident, right? It's and it had irreparable damage. So I'm trying to think of like a famous work accident where there was irreparable damage to a machine. Does anybody know any like famous work accidents? I always know like The Simpsons, right? They have like how many days since the last work accident, like when Homer's there. I think in psychology class, right? Did you guys ever learn about, I think his name was like Phineas or something, the dude who was like at work and then like a pole went through his head and it like completely cleared his head and didn't touch any like memory part of his head. Yeah, so there's like some dude who got a spear through, and this is like exaggerating, I don't know the exact facts, but essentially he was normal after all of this. There was nothing, and this was one of the ways they identified certain areas of your brain that are more important than others, like for maintaining a normal life. But we'll just say, that's kind of an extreme example. I can't think of anything more creative than that off the top of my head, but some kind of work accident happened. Somebody was messing around with the cookie dough, put too much flour in, and then it just, went everywhere. The machine was done. And, they didn't want to clean it up. It would be too hard. They just got rid of it. So that wouldn't be explaining the accounting rationale. That would be like more explaining like factually what happened. But let's look at it here. We know we had a machine, something bad happened to it. It's now done. We got rid of it. We didn't sell it for anything. So this is a little bit different. We didn't sell it. We just got rid of it. So it happened at the beginning of the year on January 1st. So much like example A, we don't have to worry about accruing depreciation for the year. Where it sits is where it sits, and that's what we dispose of it as. So when we look at it here, if that's the case, we have to, we got rid of the machine. It's on our books at 85. So we're going to credit machine C for 85,000. In this case, looks like our AD on it, our accumulated depreciation is 64,000. That's at a credit balance. To get rid of a credit, we got to debit it. Credit AD for 64,000. We didn't sell it for anything, so we don't have kind of these proceeds type items. So, but we do know that our debits have to equal our credits. So what this essentially means is we suffered a loss for 21,000. So that was A, B, and C. The other famous psychology example was like Kitty Genevieve or something, right? You guys ever hear of her? So it's like some lady was, we could talk about psychology and accounting, right? We could be a little bit interesting. So this is the idea, like if you're ever being attacked or something, you should say like, instead of saying like help me, like generally, you should say like you help me, like call someone out specifically. The reason being is, so the story with this Kitty Genevieve lady was she had gotten like attacked or something outside an apartment building, and she had screamed like help and stuff, but all the people in the apartment building thought somebody else would take care of it and help her. So it's kind of like a diffusion of responsibility. So that's, one of the stories with it is, one of the learning lessons is, like if you're attacked or something, you're supposed to say like you help me, because then it doesn't diffuse the responsibility among people who can help you. I think you're supposed to yell fire or something. I don't know if that's the case or not, if that's like the new thing, but that's like the other famous psychology thing. I don't know if that's, we can tie this into the next problem here, but maybe we can. Let's see if we can figure some workaround for it. So it looks like, hey, the notes to the recent annual report from a corporation indicated the company acquired another company. So looks like company A acquired company B. What they want us to do here is compute goodwill, and then they want us to say, what adjustments we need, whether that's depreciation of the fixed assets and whether it's goodwill itself. And this is problem 8-9, so let me flip to it. Stanley Milgram experiment, that's another big psychology one. Zimbardo prison study, that's another one. Took some psychology classes. I'm not just a total accounting nerd. So, first off, what we're talking about here, how to tie this back into the PowerPoint. We're talking about this slide right here where we're saying, hey, company A purchases company B. That's how we calculate the goodwill here. And then we said specifically what we do is to the extent they paid more than the fair market value of what they received, so you paid more than what you literally got, that excess or the difference is going to be the goodwill. So that's what we're doing here. And we said you can test that goodwill for impairment. You establish goodwill when you buy another business. If you develop it internally, it's not recorded. So we look at these facts. Highlighter on the loose, watch out. So Susie acquired Steve's shoes, so A acquired B in the current year. Acquired the name and all of its assets. So it looks like, hey, purchase price here, they paid $750,000. And looks like an independent appraiser estimated the following market value. So that would mean fair value of these assets. So, if you were to look at this, not a balance sheet, because a balance sheet is the book value. We had a third-party person come in and say, hey, here's a separate report that shows the fair value. And it looks like they compare it, book value and fair value, market value. So what we're going to do here is compute the amount of goodwill. So basically here, if we were to turn this into a journal entry, or just looking at it, we know cash, in this case, we paid $750,000. However, we need to look at specifically here, what are the identifiable assets that we actually received? So what we received here were accounts receivable. It's something we physically received that's worth $50,000. We also received the physical thing we received is inventory. That's worth $350,000. We also received fixed assets worth $208,000. And then other assets worth $10,000. So all in, we received $618,000, the value of all these. So we paid $750,000 for business, and the physical things that business gave us, like physically what we received, what it's actually worth, are $618,000. So what that means is we paid an additional $132,000 for goodwill. So that's the idea. To the extent you have an excess So the excess of the fair market value of the assets you received. So we paid $750, 618 of which was for the fair market value. The excess or remaining was $132,000. There we go. Now, what they want us to do here is they want us to record depreciation on the fixed assets. So here's the fixed assets right here, so 208,000. Let's take care of that. And they're using straight line. So how we would calculate this, the depreciation expense, our cost would be 208. Remaining useful life 10 years, no residual value. So 0 residual value times 1 over 10. It's going to give you 20,800. So debit depreciation expense, credit AD, accumulated depreciation, 20.8. So likewise, because this goodwill has an indefinite life, we're not going to subject to amortization, right? You don't have a time period over which you can depreciate it or amortize it, I'm sorry. So those are the problems. Let's finish off class here. We got some multiple choice questions to do, right? We know that the exam's all multiple choice questions, so it's only fair that we do some multiple choice in class to see how this stuff is written. And like I said, every chapter, there's always optional multiple choice questions. You can always have fun with accounting. Now, I'm sure most of you are like, the homework's enough. Don't bug me outside of the homework. It's hard enough. I'm there Sunday at 10 p.m. trying to get this in. But if you want to do optional problems, that's why they're optional. They're there to help you. But the problem for me is I can't assign optional multiple choice questions because it's a two-forked road. I can either give you limited attempts, right? You only get one attempt, and then you miss it, and then you get mad because you missed it, and then or alternatively, I give you unlimited attempts, and then you just, submit it 4 times until you get the right answer. So multiple choice is like not a fun one to assign. That's why I don't make it homework. So let's look at one here. It's like mega company, and Porter Company both bought a new delivery truck. So we have company A and we have company B. So we got A and B. They each bought a delivery truck on January 1st, 2017. Both companies paid $30,000. So cost is $30,000. As of December 31st, 2020, the net book value of Company A's truck was less than Company B's net book value. Which of the following is an acceptable explanation for the difference in net book value? So what they're saying here is, hey, we bought it in 2017. So we got 2017, 2018, 2019, 2020. 4 years have passed of depreciation expense, debit depreciation, credit, accumulated depreciation. Looks like the net book value of A is less than the net book value of B. But how is this possible, right? They both bought it for the same price. Well, there's a couple different explanations here. When you look at it, they could be using a different method of depreciation. But the big one we care about, and one of the ways you could explain this is through A. So Company A estimated a lower residual value. The idea here is, get the 10 here. Both companies paid exactly the same, net book value. When we look at something like straight line, right, we know it's, our depreciation expense equals our cost minus our residual value times 1 over the life, right? The idea here is if you have cost minus residual value, if you have a lower residual value, each year you're going to have greater depreciation expense. If you have greater depreciation expense, that's going to cause greater accumulated depreciation, which is going to cause a lower net book value. Let's look at 2. So it looks like a company followed the practice of depreciating a building on the straight line basis. So we're dealing with straight line. It was purchased in 2019, the building, and had an estimated useful life. 25 years useful life. Residual value, $20,000. Been drinking coffee all day. There's nowhere to get a real drink on campus, so it's like dehydrating me. Although I did find like a secret pop machine. It's all the way in like the Union building. So if you like go in the Union, right, they got the popcorn machine on your left, and then you take like the secret walk through if it's like cold outside, you don't want to walk outside. So like right before you get outside, there's like a pop machine area. It's the last bastion of pop machines on the campus. So maybe soon enough it'll go down. Maybe I shouldn't have told you guys that because now you're gonna go all get pops there and I don't have my secret spot to get a pop on campus. So we'll see, but I didn't want to make the walk today in the rain and cold. But let's get back to the problem. So what they want to know here for 2 is, what is the original cost of the building? It's like depreciation expense for 2019 was $15,000. So essentially what they're doing here is, right, every time we've calculated straight line depreciation, which we know is, so depreciation equals cost minus residual value times 1 over the life. We've always been solving for this variable. What they're doing in this case is they're giving you, this, and this, and they want you to solve for that variable. So that's really what they're doing here. They're just giving you other pieces of the puzzle and making you solve for a different variable. So essentially with this, if we apply the facts, looks like 15,000 depreciation expense would equal our cost, which is the unknown, minus 20,000 residual value times 1 over 25. X in this case would be 395,000. So that's A. Three, this one's a little bit complicated, so let's read it through. This will probably be the last one we do for the day, given we have 5 minutes left. So they want to know, hey, looks like we sold a machine, right? They want to know what's the gain or loss on the sale. So this would be like a multiple choice version of the problem we did earlier, where we did a gain or loss. So looks like we're dealing with straight line depreciation. Looks like a company sold a used piece of machinery on December 31st, 2020. So what that means is we might have to factor in some depreciation for the year. It purchased it on January 1st, 2019 for $10,000. So there's our cost, $10,000. Had a 5-year life, 0 residual value, $2,000 of accumulated depreciation. Selling price was $7,500. So we sold a machine for $7,500, which we previously subjected to depreciation. Can you please tell us what the gain or loss on the sale is here? So We bought it. Oh. Right, we bought it on 1/1/19. We sold it on 12/31/20. Our cost is 10,000. Residual value here is 0. And our life is 5 years. So the first thing we got to do here is get the depreciation for the year, which is going to be straight line. So it's going to be 10,000 minus 0 times 1/5 equals $2,000 depreciation for the year. What we do is we add this to our pre-existing depreciation. So $2,000. So what that means is here, if we have it on the books for 10,000, right? Machine, our accumulated depreciation after 2 years will be this guy, 2,000, plus what we calculated for the current year, 4,000. So combination of those two, that means our net book value is 6,000. So we sold it for 7,500, selling price, minus our net book value of 6,000. What that means here is a $1,500 gain, B, for 3. Oops, that's going to be D actually, sorry. 1,500, not 500, 15. So that's it, guys. Like I said, we will pick things up on Monday with the in-class review. If you have any questions, bring them to class on Monday and we'll go from there.